Good day, fellow investors. One of the most requested stocks over the last month for me to analyze is KASPI. Traded on the NASDAQ, KASPI is a Kazakhstan all-in platform growing at 50% per year with a P ratio of 8. The dividend has recently been cut, but it shows the dividend paying potential, and we'll discuss that also later. However, an acquisition in Turkey and the stock price is down significantly, and we have to see whether this is now an opportunity. What we're going to discuss, my perspective here, is whether KASPI could actually be fairly priced, then whether you need this in your portfolio and the opportunity cost of having it versus having something else in it. For those who don't know me, my name is Sven Karlin. I have been value investing for almost 25 years now, beating the market in the process, and I've been doing that by analyzing and looking for great long-term value investments. And one of that potential analysis that I do constantly is also now KASPI, which is the largest all-in big app in Kazakhstan, with a marketplace, with a fintech ecosystem, and of course payments. So it's all in one on the smartphones in Kazakhstan there. They have 14 million users out of 20 million population there in Kazakhstan. The merchants are there. So you can think of it like a mega app, like the Alibaba plus more of Kazakhstan and financial everything together, and they have managed to develop that, grow that also as more smartphones enter the nation. You see huge growth there on payments, on marketplace, on fintech. We have seen 32% revenue and 25% net income growth in 2024, slowing down a little bit on what management says are one-off concerns like higher interest rates, inflation, and higher reserves for the company, and some smartphone tariffs attached to it, but still 16% revenue growth or 21% revenue growth consolidated, 16% net income growth. Everything looks good, still growing with a long runway for the Kazakhstan economy that's doing well. So everything looks really good. Here you have the spread on the revenues there. So diversified on the mega app. And then there are many these things, so you see here the strength of the brand, etc., etc. Now they have done really well in Kazakhstan, and now they have acquired Hepsiburada, which is the Turkish online marketplace, losing money. Also there were some boycotts in Turkey, inflation, things like that. So they have acquired it likely for long-term scaling and perhaps also doing in Turkey what they have done in Kazakhstan. This might be a different market than Kazakhstan, different knowledge, different required skills. The company is still operating at a loss. Also last quarter, 15% less trading there as there were some issues in Turkey. Nevertheless, the guidance there is still positive, has been lowered a little bit on some concerns in Kazakhstan, but still 15% growth should still be good. Net income still 15% growth. And if you look at the quality of the business, always look at margins, and net margins on total revenues of 4.8 billion in 2024 are 2 billion net income. So great net margins, which means great position for the business, very profitable, and if they can just keep on doing what they have been doing, they should do good. The balance sheet also looks good. The debt is only on the deposits that customers have, so practically no debt. We have to mention here that their business currency is the Kazakhstani tenge, which has not been performing great, and there is significantly more inflation in Kazakhstan than in the rest of the world, therefore also higher interest rates, which are burdening the business. But still, if we look at things from a US dollar perspective here, there is still growth, still growing, nothing wrong with it. So also very profitable, and all else equal will likely continue to do like this. Now, just a comment here on the Hepsiburada. This is something I don't like, because if you have something great in Kazakhstan, just the attractiveness of, okay, let's go to Turkey, which is a completely different market, completely different starting position, completely different set of skills required to replicate this. Why not just keep paying the 10% dividend, keep reinvesting where you know, where you own everything, and keep it boring? No, what managements usually do, they have the money, they have also acquired the Rabobank entity in Turkey with the Kazakhstan entity, because Hepsiburada does not have the money, so they have to acquire it with the Kazakhstan money to build something in Turkey, but that is just increasing the risk of things, cutting the dividend, the distribution, the shareholder rewarding. So that is something that increases the risk. It might do great, but it might also be a flop, as it often happens when companies from one sector go into another country just testing their powers. And then here they have losses in Turkey, which is perfectly normal in the context of early stage fintech products, Hepsiburada. It will be a lot of issues, a lot of questions, a lot of diverted focus, I think, from the management. But they also cut the guidance in Kazakhstan a little bit on the new smartphone tariffs, higher interest rates, a little bit less economic activity. Also, oil prices are very important for Kazakhstan, thus lower prices there. Again, they are making a lot of money, 10% tax on revenue from investments. So also something to keep in mind there for the fintech, the payments, things like that. Increase also national bank reserves to curb inflation a little bit. So some headwinds there, but that should be with the ups and downs. So interest rates also a big drag. If interest rates go down, that could also be a positive on the other hand. Hepsiburada is also traded on the NASDAQ. Of course, now they have made the acquisition there, and they will buy more of it, maybe even buy out the other investors, but it has been losing money, has been doing pretty bad over the years. Going back to Kazakhstan as a country, population 20 million, good GDP, so something like Croatia, I think, from that perspective. Very, very low population density, so that's something to keep in mind when it comes to groceries, distribution, things like that, and the costs there. The rest is good. Economic outlook good, still growing at 4.5%, slowing towards a more steady 3.5%, so nothing wrong there, but it's still Kazakhstan. So when it comes to the key questions related to the business, so yes, they have this mega app, huge monopoly position in Kazakhstan, but is it actually fairly priced at a PE ratio of 8 and 15% growth? Because it is Kazakhstan, taxes, government deficits. Oh, look, they're making a lot of money, they have a monopoly position, let's just curb that a little bit, increase a little bit taxes, some fintech, some this, and then everything is then priced a little bit down. There could always be issues in Kazakhstan because it is a big country here. However, you never know what might happen, and I have asked a little bit ChatGPT to help me there, what's going on, and it is a recent, let's say, normalization of things. The transition of this power with a little bit more democracy happened just a few years ago. There have been protests, civil unrest, things like that, bloody January. So again, it's not just calm for long term. So there are still authoritarian governments and human rights concerns, economic strains, fiscal reforms, Russia, and things like that. Because when it comes to frontier markets, I am from Croatia, so I know a frontier market very well. When you're an international investor, you have to think about foreign funds start buying, but really shy. However, due to the limited depth of the markets, when those foreign buyers sell, it's absolute destruction. This was the Croatian market. There was some funds, some Norwegian funds buying here, and when they started selling for whatever reason during the crisis, it just was a complete destruction. So that's also something to keep in mind. Do you need the ugliness of what can happen? You never know what can happen in Kazakhstan. You can spend a lot of time learning about what can happen, which then again, does it justify working so much for a free 5% portfolio position that you might open in Kazakhstan? So the second question is, it might be fairly priced for Kazakhstan. Do you want to own it? Because Kazakhstan, 15% growth, 10% inflation, things like that. So everything there seems to be okay priced when it comes to investing. And the P ratio will not go suddenly to 20 for you to double your money. You will get that growth above inflation, which then in some exuberance can give you more, in less exuberance will keep you flat. Second question, do you want to own it in your portfolio? And the third question is the opportunity cost. Kazakhstan, complete destruction. Let's compare it to Berkshire, US. I think it's valued now at 4% earnings yield. Let's put 3%, 4% growth. You will get your 6-7% from Berkshire. There is a margin of safety. We calculated around 700 to 900 billion. Unlikely to go lower than that. So you avoid the total destruction that can happen, and you can park your money here. Check my Berkshire stock analysis for a full video on that. For me personally, this goes into the too hard pile. I have seen the ugliness when anything in all those factors, government, monopoly, current position, future position, interest rates, inflation, when some of those factors work backwards, Turkey acquisition, it gets really, really ugly, and then they are spending the good cash from Kazakhstan into Turkey, where they simply don't know because it's a completely different country. And therefore, for me, it's too hard pile, too risky. You see how it might fit you. I hope I have given you my perspective of things, which is what you asked when you asked for this analysis, and many of you did. Check my other work. I'll see you in the next video.